Hello everyone, this is Praveen Shah from the Party Story. Welcome to my first live stream, and I'm fortunate enough to have someone like Pushkar Singh today on our show. Uh, just to give you a brief background, that just like any founder who would join today, and I really look forward for many founders to join in today. I thought of many doubts that I had in my mind, and there is this, and the concept of funding is so complex, and I just thought that the best way is to reach out to somebody who can talk to me about this. And like me, there are so many founders, and then we thought that why not go live and address this point one by one. So today here with me there is Pushkar Singh from Trimis Capital, which is a very big, which is like a sound deal advisory firm. They handhold, and Pushkar is great in his content, and no founder today can miss his content. So let me invite him, and Pushkar is here. I'll let Pushkar also speak. Hi Pushkar, welcome to my first live stream, and I hope this goes well. Please talk about yourself, and then we get on with our fantastic questions.
My pleasure, Praveen. Many thanks for having me. I think you gave a great introduction, so I don't need to say anything about me. But why
I
don't
think
you
most
tell
of
us about why don't you tell us about your story? Because most people are interested in learning about founders, not deal
yeah,
advisory
yeah.
firms.
Great. So I've been a founder for 20 years now. I've got multiple business, and Pahadi Story is my latest passion, and it happened to me and my wife over 2 years ago, with a very purpose and purpose come profit given mindset. So we want to give back to the society via Pahadi Story, and this is an initiative about wellness, curations from the Himalayas, and empowering a Pahadi women farmers. Just like any other founders, I am also in the startup stage. I'm struggling with my thoughts, I'm struggling with my doubts, and there is no one better than you today to solve my doubts. Yeah. So Pushkar, should we just start? Some fiery thoughts are there in my mind, and when people coming, we will start talking to them, and I hope a lot of people are joining today. So
Hmm.
So Pushkar, you know that over the years I've seen that technology has been a very hot favorite of many investors, and a lot of money has poured in prop tech, ed tech, and all the tech of the world. Suddenly, D2C is the new poster boy, and it is kind of creating a lot of buzz. What is your view on D2C as an industry, and how do you think? What is the future? Where is it leading? Is it like just a trend, or do you think it has like a very promising future?
Wow, brilliant question to start with. So, as a like the first question you should ask anyone or anyone should ask us is why do VCs invest in tech? Why not in
Hmm.
non-tech businesses? Because you can
Yeah.
also make profitable non-tech business. It's but what VCs are after is scalability. Tech gives them
Correct.
that scalability that, all right, a business can expand quickly through technology. And by definition, startup is a fast growing company. So you
Yeah.
can have, say, a great grocery store where you're running a really profitable business, or even a CA firm or a firm like ours, like a deal advisory firm, where we are profitable. Our EBITDA could be 70-80%. But we are not a startup because we don't have a tech angle. We can't scale up. So to be a startup, you have to be quick growing company, fast growing company. How do you achieve fast growth? Is through technology.
Yeah.
Now, so as you rightly said, tech has been a poster boy for VCs all over the world. There has been a lot of money coming into Indian tech industry, Indian tech
Yeah.
startups. Now, where D2C comes in is because D2C also has that advantage that tech startups have. You can quickly grow a brand. So you can start a trading business where you sell on Amazon and you don't have a brand, but you're just importing from some country or from India and selling something. It could be anything. But at that level, you don't have a differentiator. You are just a trader. People don't know your brand.
Correct.
The- that business is also scalable, but VCs are not interested in that business because there
Yeah.
is no competitive advantage. What people
Right.
call moat. Like you can't defend yourself from, say, a new guy. If some
Correct.
guy starts undercutting you on a price,
Yeah.
eventually you also have to bring down your price. Like you would have
Yeah.
seen, it's a price war. But once
Absolutely.
you create a brand, the advantage of brand is it gives you a moat.
Yeah.
It gives you a competitive advantage. And
Correct.
that's why VCs are so interested in D2C is it has competitive advantage and you can quickly scale up the business. You don't need to spend a lot on capex, a lot on infra. You can pretty much outsource everything manufacturing. All you
Yeah.
need to do is brand and sell through marketing, through branding, and then ensure quality is there, great customer.
Lovely.
service. And
Lovely.
that's why I don't think D2C is a fad. Like coming back to your original question,
Yeah.
it's here to stay because e-commerce is growing in India.
Correct. Correct.
So as more and more people shop online, they would prefer to shop
Yeah.
like everything, all their needs on websites or marketplaces. So
Yeah.
all these traditional FMCG companies also pivoting on e-commerce websites. Procter and Gamble, HUL, PN, whatever, ITC, Reliance, everyone is trying to sell online, and so
Yeah.
are D2C brands.
Right. Right. Great. Fabulous. Really, really good answer. So just to gather from what you're saying uh, is price is no longer a competitive advantage. I think the edge is towards a brand storytelling and building a brand, and of course all kind of traditional practices have to come in, but it is the brand solid connect that kind of gives somebody an edge over a commoditized business, right? If I am summarizing it right.
So that's correct. That I won't say price is no longer like price also plays a role, but
Yeah.
it depends like what category you operate in. Say if you're creating a very mass D2C brand, where the people you are targeting are more price sensitive, then price will play some role. But say for niche luxury brands, price is not so important.
Got it. Got it. Fabulous. Fabulous. I think we're just getting started. And you rightly pointed out that there is a future for D2C business, and that is coming out from the man himself. So, this is a great answer, Pushkar. And it gives me confidence myself for my own brand.
Why did you start your D2C business?
Great answer. So it is a personal, we started buying so much online, and then I thought that there is tremendous potential in reaching out to such a mass population, which is like a digital native consumer, which is already evolving. And then on the other side, we were in the mountains and we found this amazing inspiration from the Pahadi women farmers. And there's this whole social impact part to it. So one side we saw purpose, on the other side we saw a huge potential of audience that is waiting for such amazing and curated products. And this is basically we were just trying to bridge the gap, and that gave an edge for us to start the Pahadi story. It is a story of purpose, it is a story of impact, and it is a story of curation from the Himalayas. So these are three pillars that gave us an edge to start the Pahadi story.
Okay. And how would you define, say, the core value or ethos of Pahari story, as you said? Himalayas is one. Second
Yeah.
is purpose. And then,
Social impact, giving back. Yeah, these are the three pillars, core ethos around which we create everything. And like, there's like the guiding light for us.
that why did you particular pick Himalayas? Why not some other region?
Ah, Himalayas. So I love mountains, and I think I found my inspiration in the Himalayas. So somebody loves property, so they start property tech, prop tech. I love Pahad, so I
Okay.
started the Pahadi story,
So you're following your heart.
following my heart. Yeah, and I think it'll lead us someplace. Great. So another question now. So like you rightly pointed, there's like a future for the D2C brand. The most fundamental question here is, Pushkar, is that what do investors, because you work with so many and you're yourself an investor, what is that X factor, or could be two or three factors that investors look for in a D2C business today? What is the edge? Like there could be 10 standing in a queue or to raise money. What is it that, who is it that you would pick?
So you have to realize D2C in India is a very quickly evolving sector. Because unlike say other, and I talk about it a lot, that why do so many people do D2C brands and not say a SaaS business or a tech business?
Yeah,
Because you don't need to be a techie to create a D2C business. As
right,
long as you understand how to create a brand, and this is something you can easily learn, you can create a D2C brand because you can pretty much outsource everything.
right,
So this brings down the entry barrier that
correct,
pretty much anyone can start a D2C brand. You don't need a lot of money to build a brand and start selling on Amazon.
right,
So this is proving to be a slightly difficult scenario. Why? Because now the competition is intense. Now, if you're doing a SaaS business, if you're creating a SaaS product, if you have a great background, you know what you're building. Like there are really high chance that some venture capitalists will fund you, some VC will invest in you, going by your background.
yeah,
D2C, that's no longer the case. You have to show revenue. You have to show validation. If you go to a VC at an idea stage and say, hey, like the stage you are right now, Kavi,
Yeah,
I want
yeah,
to start Pahari Studio and Ayurveda brand, investor will say, yeah, it's a great idea. Why don't you do it? And show
yeah.
me some revenue before you come to me. No one
Right,
is going to put money at an idea stage.
right.
So earlier VCs used to, so VCs always had a revenue threshold in D2C. It used to be 40, 50 lakhs every month. That
Yeah,
once you have reached 50 lakhs revenue every month, you are ready for an institutional round, like a round
right.
of above $1 million, what we call an institutional round in this country, pre-series A rounds. Unfortunately, that threshold has changed. Why? Because now there are so many brands and almost all major categories are very crowded.
Right.
So if you are a new D2C founder, it's very difficult to raise investment if you say, hey, I'll do just another cosmetic brand.
Correct.
Even in cosmetic brand, if you slice cosmetic brands, now we have coffee-based cosmetic brands. Like
Yeah,
M Caffeine is one company who have raised a lot of capital, but then
yeah.
there are others who are using, say, coffee as the base material to create cosmetics.
Correct.
So even coffee cosmetics are getting competitive. So now, if you are a new D2C founder and if you want the X factor, you need to do something different. Pick a category that still hasn't come to India, but you think a lot of people will benefit from it. It will have a big demand, and then try to create a brand on that. It's of course difficult because
Yeah,
you also have to educate the market. Like
yeah,
it's very easy to sell, say, caffeine, caffeine or coffee, or say coffee. You'll see like there are maybe like 50 coffee D2C brands,
yeah,
but can you say something else like some other beverage in India? It still
yeah,
hasn't arrived in India. Can you sell bubble tea?
yeah.
So that's the question. That's where the new wave of innovation will come from.
Got it. Got it. Okay. So just to summarize again, what you're saying is that in the entire range of categories, there has to be one up from somebody else. So that is one X factor, that an advantage basically over others is what you're trying to say. But I have one more question here, Pushkar, and actually you answered my other question already. But just to bring one question here is that sometime I get confused as a founder, and let me be very honest that same category brands, they get invested again, like there is coffee X, and then there is coffee B, and there is coffee C, and each one is getting money, and the total addressable market is same. So how do investors judge such companies, such startups?
So, especially coffee, because it's a great example. Like India is Indian D2C coffee is crowded. There are literally 50 D2C coffee brands. There's also a marketplace for D2C coffees where you can
Yeah,
just go and buy different D2C coffee brands. The advantage for coffee is it's still a very niche sector in India. Not a lot of Indians drink coffee. And by that I mean brewed coffee. Like, of course, South India people drink filter coffee, but the
yeah,
kind of coffee they are selling is slightly different. It's specialty coffee, like really high quality beans. Now that market is increasing.
yeah,
So even though you'll see, all right, we already have Blue Tokai, which is slightly big,
yeah,
then do we need other coffee brands? And there's of course no barrier, like anyone can start a coffee brand. But
yeah.
investors are still funding coffee brands. Why? Because right now the size is so small that they think this market can become massive.
Oh, okay.
Because see, on the other side, if you look at tea, now there's not so much innovation on D2C tea. There's of course
Yeah,
Badam tea as one
yeah,
big company, but there
yeah.
are not so many D2C tea brands. Why? Because it's very difficult to differentiate from the tea we regularly, like if you want
Yeah,
to drink a leaf tea or some really specialty tea, you can go to a good supermarket and buy it. It's
yeah,
easily available. People have been drinking that.
yeah.
And all big companies, all big FMCG giants have also high quality tea. There are
Right.
also dozens of estates in Assam or different parts of India where they sell you, like maybe Himachal, where they
Right.
sell you high quality tea.
Correct.
Coffee, like so far, like Nescafe or any other coffee giant, they were just selling instant coffee in India.
Yeah.
So specialty coffee wave is just catching up.
Okay.
So the
Great.
market, that's why VCs are funding because market is exploding. It's still a very small market.
Yeah. All right. Great. We have a lot of questions coming in. And guys, if you're listening, I'm going to open the questions. All the questions we will try and get Pushkar to answer. And they're fantastic. And Neha, just to answer you quickly, this session is recorded. I will repost it, and Pushkar is also reposted. So coming back, Pushkar is, because I follow you and I keep reading, and then you broke that 50 lakhs MRR is passe, and it kind of put me back. I said, अरे अभी तो 50 लाख करने ही वाले थे. पुष्कर बोलता है 50 is nothing, and you say no, 70, 80 is the norm now. So, entrepreneurs or founders who are self-funding or doing bootstrapping or taking from friends and family, and they would get so far, and then again to get from 50 to 70. So do you think at that stage also they should take funding to get to the institutional round, just like a mid gap funding?
So you have to invest some capital. Assuming, say, you are creating a great brand, you're not investing a lot on marketing.
Yeah.
But still, you need to invest in working capital, what we call inventory. You need to have stocks, right? Now, to do 70 lakhs revenue, 70 lakh month, or say 50 lakh monthly revenue,
Yeah.
typically people put 2-3 months of inventory, like people on the cost price. Now, assuming your gross margin is, say, 40-50%, you need to have around 1 to 1.5 crores of inventory ready. That's only inventory. Now you also need to spend something on marketing. You might have to, and you can't really, like two founders can't really do a 50 lakh business. Maybe you need a couple of guys for
Yeah.
customer service.
Yeah.
So the advantage of D2C, it's a profitable business, but you would still need to invest some money.
Got it.
So if you can do it by yourself, great. A lot of founders don't have that capital.
Yeah.
And since VCs are not interested, it makes sense to raise capital from your friends, family, or angel investors. That's the gap angel investors fill in.
Got it. Got it. All right. Understood. Fantastic. Coming to my another question is, there are so many models that a founder gets exposed to. There are multiple Excel sheets, investment bankers will handhold, and of course, I've worked with you. So just to break down a simple model, Pushkar, like when you say MRR multiple or ARR multiple, could you just elaborate a little, because there are founders who are asking such questions here, and if you can just throw light, what are the fundamental model of valuation?
So I must have written, I don't know what, 10 posts about it. I just hope it's not repetitive. But like VCs give you a multiple of your revenue. Say your annual revenue is 5 crores. So they'll say, all right, I'll give you X multiple of this revenue as a valuation. Now, this X varies between right now in India, it of course keeps changing depending upon demand and supply. Right now in India, for 90% brands, this X is between 3.5 to 5. Okay. So if your revenue is, say, 5 crores, you can expect a valuation of, say, 17.5, or let's say 15 crores to 25 crores. Okay. Assuming you are a normal guy. Now, of course, there are some companies like Licious who get a 10x valuation, or Mama Earth who get a 7-8x valuation, because they are massive and they are category leaders. So they really have an advantage. Like with some, they can become really massive, and become, say, Mama Earth can become HUL of baby products, something like that. Yeah. So you should not compare yourself with them. Those are exceptions. For early stage brand, 3.5x to 5x is what I have seen. But there is one catch, and that's an advantage for founders. So, say last year your revenue was 5 crores. VCs don't consider your last year's revenue as your multiple. They use a term called ARR, which is annualized revenue run rate. This means your last month's revenue. So your last 12 months revenue could be 5 crores or 6 crores. Right. But then, say, right now we are in May. So last April's revenue versus this April revenue, of course you would have done more this April, right? Because you're also growing. You're growing maybe like 10% every month or 15% every month in early stages. Right. So even though your revenue could be only 5 crores for last 12 months, last month's revenue could be as high as, say, 60 lakhs. Right. So then your ARR becomes last month's revenue times 12. Wow. Monthly annualized revenue multiplied by 12. So we call it ARR, which is again that 60 into 7.2 crores or 8 crores. So there's a delta over there. Your ARR is always, I would say 99% cases, more than your last 12 months revenue.
Right. Got it. So just to summarize again, your question is that we don't look at the financial year, but we look at the last month revenue multiple of 12, right?
That's correct. Great. Very easy way to understand.
Yeah, fantastic. You have a lot of questions coming in, Pushkar. Do you want me to pick up questions now, or should we do it towards
Yeah,
the
yeah.
end?
I think we should take some questions now.
Okay, so now I think one question is very relevant at what you answered is somebody. Okay, so Giridhar, hi, Giridhar Gopal. So he said that will this valuation be applicable to D2C brands which are offline and online both? So I think he's saying about hybrid model, the same valuation application.
In most cases, yes, but in early stages, most D2C brands are online. At least 90-95% revenue is online because it's much easier to scale an online business as compared to, say, modern trade, opening your own stores. You can also try the offline channel, but as a niche brand, it's very difficult to find shelf space in best
Yeah,
supermarkets.
yeah,
So that's why everyone does it online. But say once you're at 100 crore revenue, of course you'll have a mix of online and offline. Then you
correct,
can't be an only online player. So it's
correct.
easy to achieve 30, 40 crore online revenue. After that, most brands start doing some offline sale because
Yeah,
that's still a bigger category in India. Even though
yeah,
online is growing quickly, like offline still accounts for a much larger share.
right,
So this valuation is true for both online and offline. Late stage brands get a higher multiple depending upon how dominant they are in their category,
right,
like Mama Earth, Holicious, or all these both these great brands. And early stage, 95% D2C brands are online because it's very
right,
difficult to scale an offline brand. If you
correct.
start with an offline brand, most VCs would like to know, hey, why are you doing offline? Why
Yeah,
not online? Because online is easier. So you
yeah,
better have some compelling reasons that, hey, I have
correct,
a background in modern trade. I think I can scale up offline. And that's why I'm doing offline. But
right.
you'll still get broadly same multiple, assuming all other numbers are broadly same.
Yeah,
Margin, growth.
yeah. I think the model from of brick to click. I think this is looks at click to brick. You know, first you start the click business and then you go into the brick. Somebody told me, and I remember this term so well. I want to just bring out this question, which is very interesting, and it is from Pranav Obrai. The answer that you said that the last month revenue into 12, he's saying that wouldn't a founder inflate it just before fundraising? How would you screen such a thing?
So, by what do you mean by inflating? One way is you spend a lot of money on marketing and say offer discounts to grow the business. So, if see, you can't fudge the books, otherwise, there is no deal. My assumption is you're saying I'll spend a lot of money on marketing and then try to grow revenue. In
Right,
that case, your margins will come down, your contribution margin will come down because then
right,
you're spending more on marketing just to grow the revenue. So any investor will notice that. They don't only notice the last month revenue. Say month on month, your contribution margin was 10%. Contribution margin is basically gross margin minus marketing expense, direct selling and marketing expense. So say it was 10% for a brand, 15%. Now all of a sudden, if I'm evaluating a deal and if I see, hey, last 2 months, the revenue has jumped by 50%, but
yeah,
margins have
correct,
become minus 20%
correct,
or minus 30%. There is something suspicious.
yeah,
Because all of a sudden the margin can't go down. This means you're just investing more money, offering more discounts, just trying to increase the sale.
yeah.
So this is a red flag.
Got it. Got it. Understood. So basically, of course, you'll see the CAC has grown significantly, and suddenly there is this jump on revenue, which kind of looks suspicious. So that
Right.
would, I think Pranav, yeah, you've got the answer from Pushkar. Before we take more questions, Pushkar, so uh, two more
One thing I
questions
would
for you.
just like to add. So a lot of founders think that VCs only look at revenue. That's not correct. They use revenue for valuation, arriving at a valuation. When I say like, all right, my ARR is 6 crores, I get a multiple of that. You get say a 20 crore valuation.
Yeah.
But that is only for valuation. They look at 20 different metrics, like what is your repeat rate, what is your retention, what is your CAC, what is your gross margin, what is your ROS before investing.
Right.
So just like say you just can't borrow money and then just try to increase revenue and say, hey, I'm
Yeah.
ready.
Yeah.
Like
I think.
Falguni said, due
Yeah.
diligence will reveal anything.
Fantastic. You know, a strong CFO like Falguni would clearly, she can smell the balance sheet. You know, I've spoken to Falguni multiple times. Great answer, Falguni. So Pushkar, two questions from me, and then there is a series of questions which is here. So I think we'll keep the 20, 30 minutes for that. So Pushkar, if a founder has to go through a journey of fundraising, and and if they are lucky enough to have somebody like you to handhold, but prior to that, I'm sure you expect that there has to be some homework. A founder should understand the fundamentals of fundraising. What are some tips that you think founders here should listen or should keep in mind?
So, see, the most important thing the most, I always tell to anyone that don't think of fundraising as a goal.
Yeah.
So, you can create a great business by bootstrapping. Every business doesn't need to raise capital.
Yeah.
The only advantage of raising capital is if you want to grow quickly. And if you think you can grow quickly with more capital. See, like my kind of business, I can't grow it quickly even if I have more capital. I can hire maybe 20 more people, but I don't
Yeah.
have enough business. Business will only grow organically.
Correct.
So first you have to realize whether you can grow your business quickly if you have access to capital. Then once you go down the fundraising path and once you raising from friends and family is fine. But once you raise money from either angel investors or VCs, they expect you to continue on the fundraising path.
Hmm.
Because as a VC, once I have put in money, I want the founder to keep growing really quickly, like not like say 30% every year, but double the revenue every year, 80% depending upon the stage. Now, to do that, you have to continuously keep raising capital. So once you raise capital, in most cases, of course, there are exceptions, there is no going back. You lose that bootstrap sense of business that, all right, this is my business, I run it the way I want. And that's why you'll also see, especially in once found some founders have raised some capital, there are a lot of conflicts with VC.
Hmm.
Because as a VC, I want you to grow quickly, yeah, then only I'll make money.
Correct.
If your valuation doesn't increase, like my stock value doesn't increase, how will I make money? I
Yeah.
also have to take an exit. I am accountable to my investors. So I put
Yeah.
money in my fund. Now, the once the founder say a founder raises 2 million, and then the founder says, "All right, now I want to make a profitable business. Don't want to grow quickly," which is also fine, but you can't really sacrifice the growth.
Yeah.
So this is something the founders have to understand before they go, and this is a very shift of mindset. So
Yeah.
I tell all founder like, hey, it's great you want to do fundraising, but you have to mentally prepare yourself. First, it's not a goal, it's a process. You raise capital once, you need capital again after 18 months. Then again after 18 months. You'll have to do at least three, four such rounds, assuming you
Okay.
are a successful business. So it's not a
Yeah.
one time activity. Second, you also lose some control. As VC, I'm very happy to founder to run the business because founders know it better than anyone else.
Yeah.
But it should not come at the cost of, say, the founder say, all right, now I have raised some capital. Now I'll grow really quick, really slowly. You also have to show some growth because that's where my upside also comes in. I am
Hmm.
accountable to my investors. I am not investing for dividends. Unlike a traditional investor where say I put in a crore and I get
Yeah.
10% every year. That's not
Yeah.
how VCs think. That's
Right.
not how I structure my portfolio. My portfolio is I invest in 10 companies. I know two, all 10 won't do well, but I expect all of them to try to grow quickly so that at least two, three become massive and then I get my money back with return. So this is something founders should be really aware of. Any founder
Right.
looking to raise capital.
Right. So fundraising is not a one-time milestone. It is a continuous process so that VCs also exit with a good, profitable portfolio. And so basically that kind of mindset a founder has to keep in mind, right? Is that the final summary?
Exactly, because VC now is also a stakeholder in your company. It's
Yeah.
not only so as a founder you can say it's my company. Of course, it's your company,
Yeah.
but the guy also owns 20% stake in the company, so he's also a part owner.
Right.
So see, as the majority shareholder, you have to take care of interest of everyone. You just can't say since I own 70%, I'll just try to do it my way. If you
Right.
have that kind of mindset, don't raise capital. Grow the business you want to do.
Right. Got it. Got it, Pushkar. Fabulous. Your answers are like spot on, man. Spot on. One last question from me, and then I will, let everybody is when should a founder raise money? So there is always this thing, my business is growing. Should I dilute now, or should I wait it for ripe more and then value, and then so thoda, if you can give a hack on that that question.
It's a very difficult question to answer, and I always get asked this question: when to raise capital?
Yeah.
Now I tell them, like, you raise whenever you're ready, and then everyone says it's a very stupid answer. It's a very general answer. So I'll just try to give more concrete answer. Say, assuming you're a first-time founder now, and let's keep it for D2C founders. You're a first-time D2C founder. You just start a company. You just started your brand. You can't raise capital now. No one will fund you.
Hmm.
You need to achieve a certain revenue, which used to be, and assuming, say, if you want to go to an institutional VC or even an angel investor, you want to do a small angel round of, say,
Yeah.
$500,000, 3 crores, 3, 4 crores, your revenue should be at least 30, 40 lakhs. Before that, people won't invest money in you because there's no validation. It's very
Right.
easy to do 10 lakh revenue a month just by selling something. But you
Correct.
have to show, all right, I can quickly scale up. I quickly scaled up this business to 40 lakhs. To be ready to do like a small angel round, seed round. If
Right.
you want to approach to a VC, it should be at least 70, 80 lakhs.
Right.
Once you reach that, then it's your choice. If you think you're growing profitably, you can continue to grow at 20, 30% every year, or whatever has been your growth rate so far. You can do that. Or you say, all right, I want to grow quickly. I think my business is at an inflection point where I can grow 3x revenue every year if I had access to capital. If you
Yeah.
strongly believe in that, you should raise capital. If you think I don't need capital to quickly grow it, I'm fine growing whatever rate you are growing at, 30% every year, 20% every year. Don't raise
Great.
capital. Only raise capital when you want to grow quickly and you think, hey, this is the right point where right now, with access to capital, I can take my business from X to 10x.
Right. Got it. Got it. Great. I think, Pushkar, this is again a fabulous answer. And as a founder, I have some of my doubts cleared today live with you on the show. And I think we have really, really good friends here, a lot of founders here. And I found a very interesting question which I want to beam. This one is very interesting. How important, this is from Payal Sinha, how important it is to build a team at pre-seed, pre-revenue stage, and how to do that before you have secured any kind of investment.
So, specifically for D2C businesses, you don't really need a team to start with. In most cases, there are two founders who started a business. One said, all right, I'll take care of marketing. The other said, I'll take care of sourcing. And
Yeah.
then you start selling online. As your business grows, you start adding a couple of people here and there. Maybe someone to service the customer representative, someone to say manage inventory, warehousing, and you slowly expand the team. It's different from tech businesses where tech, because in tech business you need engineers to code it. Even though you are a founder,
Yeah.
you can't do the entire coding by, maybe if you're a team of 4 founders, then you can do the entire coding by yourself at the
Yeah.
early stage. D2C, there is no coding. So I don't think it's important to hire a team. Maybe if there are two co-founders, that's enough just to start. Once you reach 10, 15 lakh monthly revenue, because first you must test the hypothesis that you say, I have this idea, I want to create this brand.
Yeah.
Instead of hiring team, just try to test whether will it even sell. Are there buyers who want to buy your brand? Once you
Right.
have tested the hypothesis for say 6 months or 3 months, you
Yeah.
realize, hey, there's some demand for this brand. Then you start hiring people. The advantage of D2C businesses is you start making revenue from day zero. The moment you sell your first product, you make some revenue. And
Right.
usually the gross margins are higher. So in early stages, the business pays for the team. So
Got it.
only hire once you're making some money and once you can afford to hire. Other way is you raise some money from friends, maybe like friends, family, someone,
Yeah.
and
Yeah.
then build a small team. But don't overhire. Most
Yeah.
businesses shut down because they overhire. And
Right.
then they realize we can't pay the salaries or they're
Yeah.
running out of money.
Yeah.
So don't fall for that trap. Early
Right.
stages, try to grow the revenue, not the team.
Wow. That's a great input. That's a really, really great input, boss. Amazing. We
You
have,
have to stop saying that, Praveen.
but there is so much of thing that we are learning from you. And I'm not doing an anchor thing which says "Arey, bahut acha bol diya." This is truly because this last point is so important. We start preempting and thinking, oh, future there'll be growth, let's start investing in the team. But actually, the revenue is growing at a slower rate, but the team is growing at a larger rate. So that gap kind of catches you up. One more question from Ashwin Jain. For a minimum revenue of 30 to 40 lakhs, how much do brands generally spend on marketing? I could answer that for you. Of
Yeah,
course,
I
Pushkar
think
will
you're a much
answer that.
better.
So, Ashwin, usually, your industry would define your gross revenue. So that is one thing that you would only understand. But typically, the CAC on paid media today is falling between 250 to 325. And with so many investors investing in D2C brands, the acquisition cost is growing and growing and growing. So you would have to understand that to revenue, to secure a revenue of 40 lakhs a, how many orders do you need a day, and therefore how do you divide between new acquisitions versus your retaining customers, and that's how you will arrive. Typically, to get a 30-40 lakh rupees business, and if we look at 50% contributing on this, and let's say if you had to get 1,000 orders to this, so your typical cost would be around 300 into whatever 500 or 1,000. So that could be the range of investments that you could look at on paid media. You could add here, Pushkar. This is my view from all that we've got gathered in last 8 months.
No, I think you are correct. There is no one answer. It
Yeah,
depends upon a lot on your industry. What is your average order value?
yeah,
So if your average order value is 100 rupees versus 1000 rupees, your marketing spend would be different. How much you are spending acquiring every customer? What is your retention? So see, I can give you a broad range. I can say 5% to 30%, but that's useless.
yeah.
There's no point giving such random answers. So I think at least I don't know one particular answer to this question. It depends a lot upon what you're selling, how you're selling, what's your gross margin, what's your
Yeah. Sorry for that. Sorry for that. Okay. Cool. So we'll go to the next one. Oh God, what is this? As an angel investor, I'm showing you one more. I'm beaming one more. As an angel investor, what should one look into when one is funding friends and family? This is question for you, Pushkar.
I think that's a really that's an interesting question. So see, the challenge with friends and family is like if a family member or close friend approaches you, it's difficult to say no because then it's also about a bit about relationships. So what you should be looking at is forget numbers because at such an early stage, numbers you're not a VC. You should not so much dig down into numbers or growth or metrics. Just try to like say since you know the founder better than most investors would know, try to assess the founder whether that person can create this brand. What is her background? What she has done in life? How dedicated she is? How committed she is? Because you have known that person for a long time,
Yeah.
so you have an advantage. So early stage back founders, not businesses. Early stage VCs also do that. They back founders. So if you believe like this person can create a great business, I have known him for a long time. He has always been hardworking, has done well in his career, been committed, then invest. If you think he's someone who just gets new ideas every year, or like who has done something right now, or you're not very confident that this person can create a substantial business, I suggest politely saying no, saying, hey, I don't have capital, or this is not what I am interested in. So take a bet on the person.
Right.
And as a friend or a family, you know that person much better than any investor would ever know.
Right. I hope that answers for you, Ashwin. And we'll go to something on top. I think a lot of people have given questions. So, guys, hold on because I'm flooded here with questions and I'll have to now pick which one to. Okay, this one. Let's pick up this one. Again, Girdar is posting a lot of questions, so let him give one more answer here. So, do you think the partners such as distribution platform, e-commerce plus payment gateways, hyperlocal, last mile delivery players to have a bright growth considering D2C scaling? So, basically, the entire ecosystem surrounding the D2C. Good question.
So I have a particular answer for this, Praveen, but what's your view? I'm also curious about your view on this. What do
Yeah.
you think?
I think there is significant, of course, growth opportunity. Whenever an industry grows, everything around it starts growing. So if I have to give an example, for example, OTT started growing. So when OTT grows, the entertainment industry grows, and therefore the need for content grows, and therefore the need for production grows. So when industry starts trending or starts having tactile shifts, I think it starts picking up every other industry and starts growing it together. So that's my view.
So there's one point I would like to add because of course D2C is growing. Forget D2C, e-commerce is growing.
Yeah.
So deliveries will of course increase. LMD, what last mile delivery, what we call LMD. The
Yeah.
challenge with LMD is so far it is a very cash guzzling business. No one has been really able to run it profitably at a scale. You can have a small delivery business, small last mile LMD business in your hometown that you can run profitably, which is fine. But all these big guys, say companies like Danzo or even Zomato or Swiggy, who were at the initially LMD businesses, now they can say all right, they're into food business or something. Initially, they were delivery platforms where you would order food and get it. So it's a very tough business to crack, very tough business to grow without burning a lot of capital. So that's a challenge I see. I don't know how much venture capital will keep seeing in the LMD business, last mile delivery business in India, because
Yeah.
no one has been able to justify the investment. But the upside is maybe in the future prices will go up. Right now, how everyone is offering free delivery or delivery at say 20, 30 rupees, people will realize it's just not possible. The price will have to go up. So industry will find a balance. As e-commerce grows, LMD will also grow. We don't know whether we'll get a really like whether small LMD players will dominate the industry, like one for every neighborhood, one for every city, or the big guys will dominate it. Because it has been a challenge to scale this business without burning a lot of capital.
Hmm.
So next generation of founders who are building LMD solutions, especially through tech, will have to convince VCs that hey guys, we have learned from the mistakes of our predecessors, and we know how to grow this business, scale this business without burning millions of dollars.
Got it. I am now beaming one more question for you. Can you touch upon selling D2C to a roll up versus raising fund from a VC? Different in terms of valuation, multiple payout structure, due diligence process. This is like an interesting question. It's only for
It's a
you.
very long question. Quickly, so roll-ups acquire your brand. Eventually, you have to sell your brand either on day zero or within 1 or 2 years. VCs invest in your brand. Roll-ups don't care about how smart you are, whether you can create $1 billion business or not. What they care about is what you have done in past. If you have created a good brand with good margin, they'll acquire it. They'll give you an exit within 1 year. You're happy to do with whatever you want with the money. VCs don't have time to grow the business. They invest capital into your business and want founders to grow the business. So founders have a substantial more skin in the game whenever you raise venture capital as compared to roll up. Think of roll up like a transaction. You sold the brand, you took 1 year to complete the transaction, you are out of it. Venture capital is a 10-year journey. You took money from a VC, you grow the brand, you raise more capital, you grow the brand. So the onus on growth in a venture capital raising scenario is on the founder. In roll up is on the acquirer, the buyer, whoever is the roll up, Global Bees, Mensa, 10 Club, whoever is buying your brand. Since the risk is much lower in a roll up model because you're just getting money on day zero, you're just selling your brand. The valuations are lower. You typically get a EBITDA multiple. So this EBITDA multiple varies between 6x to 8x in India,
Hmm.
which say assuming if you have a 20% EBITDA, this means 1.2x to 1.5x of your revenue. VCs give you a 3.5x to 5x of revenue. So that's where the difference lies. Another big difference is in a roll up, you get the money because you're selling your share. Say you want to sell Pahadi Story and I'm the buyer. I'll buy your share, you get the money, I get the brand. In a venture
Right.
capital game, company issues new shares.
Right.
You're not selling your share. So
Yeah.
as a founder, I don't get any money. The company gets the money. That money is for growing the business. So these are two big differences.
Got it.
That's why valuation multiple vary. Roll up, as I said, there's a payout structure. You can get 100% on day zero, or you can get 6x to 10x, what like 60% on day zero, then 20 after year one, or 40% after year one. VC, there is no payout structure. You just raise capital because you're not getting any payout. You get the money on day zero, you grow the business, you again raise capital, company issues new shares, you get the money. The process repeats.
Okay. But just to
Finally,
also add here, Pushkar, roll-ups versus VC, what is like the percentage in the industry? Like there are more roll-ups or more VCs, just for my understanding as
so of
well.
course there are many more VCs in India. Roll-ups have just became active last year. They just became active last year. So right
Yeah.
now we have 6, 7 roll-ups. Roll-ups have done a lot of transactions because they are also buying smaller brands, mid-sized brands. So
Yeah.
no roll-up would invest, say, 100 million in a business or 50 million, like the kind of investment we see in Mama. Most
Okay.
roll-up transactions are under 10 million.
Okay. So is
So that's why
Mensa brand a roll-up?
roll-up.
Ah,
That's
okay,
correct.
got it.
So
Great.
biggest roll-ups in India are Global Bees and Mensa. They are the two biggest guys. Then we have
Mhm.
10 Club. We have Upscaleo. We have Goat Lab. There is a new player in town. It's called Evenflow. And then there are
Okay.
also smaller roll-ups coming up.
Okay. Okay.
Like people who are buying really small brands at a 2 crore revenue and then try to grow them.
Great. We have one more question from Neha. Can you give cheat sheet like basic startup kit a small scale business founder needs? D2c wellness industry bootstrap can focus on example websites, social payment, packaging, main focus areas to start with.
Praveen,
Hmm.
that's your question.
Hi
You are
Neha.
the founder. I am just advisor.
Okay, I think Neha, the before all this comes in, what comes in is basically the reason why. So first is we start with the reason why right at the core, which defines the business, defines the purpose, and defines the consumer persona. Once you have these three things clear, everything else is basically a vehicle to achieve, whatever that you are setting out to achieve. So if I had to start with today, the party story again, I would definitely have a document that defines the brand, which is whom am I talking to, what is difference about me, and therefore what are my end goals. So these are three factors around which we will create the brand persona, and then we will start curating products. After that, the next big step is going to be, if it is D2C, then definitely if you're speaking about wellness, then packaging plays a very big role. So your packaging narrative, your content is very important, and then you start posting it on platforms. So if you want to use your own website, so of course Shopify is the way forward, which I think every founder speaks of. And if you want to engage with marketplaces, then all the marketplaces are available now in today's age. I think we're in the best stage where all you have to do is have a big idea, and everything can be aggregated like in like 2 days. You have a website, payments get integrated, logistics get integrated, so you're ready to go live like in a couple of weeks. So this is in a nutshell a cheat sheet. You can DM me and I can also give you a small checklist that we already have. So I hope that answers for you, Neha.
One question, Praveen.
Yeah.
So when you were creating Pahari story, did you create a playbook or what Neha said, like a startup kit, saying,
Yeah,
"Hey
yeah.
guys, these are 20 things we want to do, and in this order."
Absolutely, absolutely. So consumer persona, basically, consumer persona, Pushkar defines everything. Whom are we talking to? So when we create any brand or any story, whom are we talking to defines everything. Is it SECA? Is it SECB? Tier one, tier two? What kind of audience are we talking for? That kind of defines the reason why we exist. And then we created a whole playbook that this is what we will speak of. This is the brand personality. This is the tone of voice. This is the visual imagery, everything around it. So these are like the yardstick. So we don't go very far from it. We definitely play some time, but these are kind of like the benchmark that we've set.
Okay. Wow.
So one more. For people starting their angel journey, how should one allocate, say, 25 lakh per year, earmark for startup funding? What are the best networks to join? Join Tremis Capital. Why look for?
So Karan, good question. So I think 25 lakhs is also a good number. The thing you should realize is like startups are slightly riskier startup investments at an individual level, but the risk reduces at a portfolio level. So always try to build a portfolio. If you want to put in 25 lakhs every year, don't invest more than 5 lakhs in one startup. So in that way, you can do 5 deals in a year. Over 3-4 years, you have a portfolio of 20 startups. So
Yeah.
once you build a portfolio of 20 startups, and in general, if the quality is average, you'll make money. A few will go on to raise capital, and then some big VC will come in and buy you out. So this is typically how angel investors make money. Most don't wait till IPO. So first point you should always remember, diversify. Don't put entire 25 lakhs in one or two startups. If you're putting in 25 lakhs every year, invest at least in five, even more if possible. If you can put in three, put like do 8 deals. Try to create a wider portfolio. Best networks to join is, I think there are 3, 4 in India, Angel List and Let's Venture
Angel, yeah.
are the best guys. On both these platforms, there are multiple syndicates. So
Right.
syndicates are like we have a syndicate at Premise Capital, where we get you can join, you can apply to join any syndicate. A syndicate manager gets a deal, does the due diligence, understand the founder's vision, and then says, "Hey, this is a good company. I want to put in say a crore from my syndicate." So then, once he's happy with the company, he believes in the founder. The syndicate manager circulates the deal to the syndicate members. As a syndicate member, you have a choice. You want to put in 3 lakhs, you want to put in 5 lakhs, you want to put in 10, or you don't want to put anything. You want to pass on this deal because you don't find it exciting. So that's the best way of getting a good deal flow. Join 2, 3 best syndicates in the country.
Great.
And there are hundreds. So join some good syndicates, you'll get good deals.
So there's the route is always joining a syndicate. No, Pushkar, there is no way that a individual should invest directly in a startup, right?
You can also invest directly. So on Angel List, there are a lot of open deals where you
Hmm.
can invest, which no syndicate is running. The problem is the best founders don't prefer that route because as a founder, if 30 people are investing in my business, like I have 30 shareholders, now I have to send updates to everyone.
Yeah.
You have to give information rights. You have to take approvals from
Yeah.
everyone. That becomes complicated. Whereas in
Right.
a syndicate, you're not a shareholder of the startup. Syndicate is the shareholder of the startup. You
Right.
just own some, think of it, you own a share in the syndicate owns a share in the startup. So then as a
Right.
founder, I only have to take approval from one person. I only have to inform one person, send monthly update. So that's the route most smart founders prefer.
Hmm.
Taking money from a syndicate rather than taking money from individual investors. Unless you are someone like Kunal Shah or Kunal Bahl, like you are a big guy, so then of course founders will be very
Okay.
happy to take you.
Got it. There's a question, and I want you to answer this. I would have answered this, but I want to hear your opinion. That significant importance given on customer retention, repeat customer, or it's more about acquiring new customer. What's the percentage one should look at? How would you evaluate a portfolio, Pushkar? Would you evaluate a company that constantly requires new customer or is really riding on a lifetime value? How do you evaluate?
So not only me, everyone knows retention is much more important than new acquisition.
Hmm.
So if you're able to retain a customer, and if the customer does repeat purchases on your platform, on your website of your brand, like you have a big advantage because you don't have to spend every time to acquire that customer. Why people acquire new customers is it's difficult to grow quickly only through existing customers. Say you have 100 customers. Now everyone say buys once every month. So then you're not growing because even though you have 100% retention and even though your frequency is amazing, like people are buying you once every month, you still have 100 customers.
Right.
So to grow, you have to acquire new customers. But if you're losing customers, that's a red flag. That means the simple answer is this means you don't have product market fit. You spent money, you acquired a customer, the customer bought your product. If no one is coming back, there is something problem with your product. Either you're
Right.
not selling it to the right people, or people don't like your product. So you don't have PMF. You can't grow a big company unless you have achieved product market fit. So it's customer retention is much more important than or repeat customer, much more important than new customers. But growth comes through new customers.
Great. Okay, so I'm flooded with question, Pushkar. So I'll take two more questions and then we can decide.
Okay,
Okay, so let's
now we have 5 minutes.
let's take Falguni's question. What's your view on VC's approach and response to offline D2C business more in light with today's time and scenario? That's a question for you.
So far, we haven't seen many D2C brands starting with the offline route, at least as I said in the initial stages, because it's very difficult to scale. If you want to do 50 lakhs revenue and you're just starting out, it's difficult to do it through offline channels. You can do it, it might take you a really long time. Say you slowly acquire one store at a time. So, why VCs prefer online business is that scalability comes with the online business, at least in the earlier stages. So you might say, hey, but offline is more profitable because my marketing expense or the take rate that I give to platform, say Amazon takes 25%. I spend 10% on marketing, that's 35%. Whereas if I sell offline, I only give 10% to retailer or 20%. It might happen that margins are slightly higher in offline. I'm again no expert in offline business or any retail. I'm just saying, even if offline margins are higher, VCs prefer online. Why? Because online gives you scalability. You can quickly grow a business. But nevertheless, if you can show quick growth through offline business without a decent margin, all VCs would be interested if you can crack that code. Unfortunately, it's a difficult code to crack.
Okay. We'll pick up one last question, and that's from Reena. Apart from revenue, the
Wow.
next top five factors you would judge a prospect D2C brand on. Fabulous.
To
Fabulous.
judge D2C, wow. That's so again, I said revenue is one, but revenue mostly determines valuation. The important thing is for a D2C brand, retention ratio. How many customers or repeat purchases? How many customers are buying it back? Your customer acquisition cost or CAC. Has it
Yeah.
increasing? Has it gone down? Has it stayed same? Frequency, number of transaction every customer does in a year, which gives us the lifetime value of a customer. That how many, say, if I spend 1,000 rupees to acquire a customer, what is the what is the business that the customer will give me over 2 3 years, assuming the
Yeah.
customer stays with me for 3 years.
Yeah.
And then I would also think ROAS, return on ad spends, how
Hmm.
effective you are in acquiring new customer. If you're spending 100 rupees on ads, how much you are
Right.
getting, and also gross margin. Typically in a D2C business, it's difficult to make a business at 30 40% gross margin. Your
Hmm.
gross margin should be slightly higher, at least above 50% or more, 60 70%. Because then you have platform fee, you have marketing expense, you have salaries, you have logistics, packaging. So your net margin comes out to be, say, 10 15%.
Right.
But to achieve that 15% net margin, you need to do at least 70%, 60% gross margin. So
Hmm.
these are 5 6 factors VCs look at.
Okay. So these are all KPIs, Pushkar. What about softer value, which is like an intangible, which is the brand value or like the brand equity? Would you also not rate that?
Yes, but at an early stage, it's very difficult to judge brand value unless you have
Hmm.
not become a big brand.
Yeah.
So, see, there is no way to judge how customers feel about a brand. You can take some customer feedback, and most VCs do that. They try to speak to some customers, go on Amazon and look at reviews.
Hmm.
So, what you said, reviews, that's very important for roll ups.
Yeah.
All roll ups look at reviews because reviews give you a moat. But at an early stage, of course, VCs also look at reviews of brand persona, but it's slightly more difficult to judge at a 50 lakh brand or at a 1 crore brand. If you're doing a crore
Hmm.
monthly, that what is the brand, softer values. So it
Right.
becomes more difficult.
Great. Okay, let's take this last question. My question for D2C, any benchmark for return customer that, acha, I think you quite answered this, but you can just summarize it once.
No, I think this is for you. What return? Okay, investors look at. I think, see, again, there's no, the higher the better.
Yeah.
But assuming you are selling something, you're selling, say, a cosmetic, which people buy every month or every twice every month, it should be at least 30 40%, even more. That once you have sold to someone, people keep buying you. But say if you sell something like a furniture, people don't buy furniture so often.
Hmm.
So your repeat will still be higher, but you have to take a longer time window. You have
Yeah.
to see whether customers are buying furniture from me again in 2 year window. Whereas
Right.
cosmetic 2 year window doesn't make sense because you use a shampoo every month. So if
Yeah.
someone is waiting, if you're saying like, all right, I'll take a 2 year window to define my repeat customer, that's the incorrect timeline. You have to take shorter timeline. Where for high value items, say for a treadmill or any fitness item, you can take a longer window because these purchases are slightly less frequent.
Right. That's for now. And Pushkar, I think you've quite opened my mind on my doubts and whatever thought process was missing. And there are a lot of questions, and I would request people that we would try and answer whenever Pushkar has time, or if these questions are available there. I hope this session was really insightful and exciting for everybody. And if you really like it, please put a thumbs up for both of us, and we will try and come back sometime. All right. Thank you,
All right.
Pushkar, for your time.
My pleasure, Praveen. Many
Thank
thanks.
you.
Great
Thank you,
session.
everybody.
All right. Bye.
Thank you. Thank you. Thank you, everybody. Thank you. Bye. See you.